Welcome to this explainer breaking down NALCO's latest earnings report and market outlook for August 2026. I am thrilled to have you here today as we unpack the massive and honestly often invisible forces shaping the global aluminum industry right now. We're going to look closely at a company operating right at the intersection of surging domestic demand and a wildly fluctuating global commodities market. But hey, before we can even begin to unpack NALCO's bottom line or dig into their specific operating costs, which is going to be a major focus for us today, we have to start by asking the most critical question in the commodities market right now. Where exactly are global aluminum prices heading next? Because in this industry, the macro environment absolutely dictates the micro reality. To get to the bottom of that, here's our roadmap for today. We're going to cover the global LME price outlook, drivers of market volatility, NALCO's financials, India's domestic demand, and finally, future-proofing NALCO. All right, Section 1, Global LME Price Outlook. Let's look at where those benchmark prices are projected to land for the year. For the 2026 calendar year, the London Metal Exchange, or LME, aluminium price is expected to remain incredibly robust, averaging somewhere between $3,200 and $3,300 per ton. Now, to put that into perspective, that is a highly lucrative neighborhood for producers, providing a massive cushion for margins. But as anyone who follows commodities knows, a high average certainly doesn't mean a stable day-to-day market. Moving right along to Section 2, drivers of market volatility. Because getting to that high price point is far from a smooth ride, and we really need to understand the currents underneath that wave. We are basically watching a massive global tug-of-war over aluminum. On one side, pushing prices up, you've got these resurfaced geopolitical tensions in the Middle East causing all sorts of logistical disruptions, plus sustained global demand for renewable energy and EVs. But then, on the flip side, pulling prices down, we're seeing a staggering 222% surge in Chinese exports, right alongside increased Indonesian output, which is alleviating some of that supply tightness. Throw in U.S. tariff policies and a highly resilient U.S. dollar backed by the Fed's firm stance on interest rates, and well, you've got a perfect recipe for wild price swings. And further tightening the screws on this whole dynamic, global inventories are sitting at historically low levels of just 0.26 million tons. Because there's practically zero buffer in the system, the market is expected to remain in a deficit throughout the second half of 2026, before gradually moving toward a more balanced position in 2027. When inventories are this low, any small geopolitical hiccup gets magnified instantly in the price. So what does this all mean for the outlook on aluminum prices? Ultimately, market analysts agree the true direction going forward will hinge heavily on three core macroeconomic indicators: the decline or rise in oil prices, lingering concerns about inflation, and the interest rate outlook from central banks like the Fed and the ECB. Essentially, if you want to know where aluminum goes, watch energy and watch the central banks. Okay, Section 3, NALCO's financials. With all these macroeconomic winds whipping around, how exactly is NALCO navigating this turbulent environment? Well, despite all those global pressures we just discussed, NALCO delivered some seriously impressive aggregate financial highlights. They generated over 7,700 crore rupees in total profit before tax for the reported periods, leaving them with a profit after tax of over 5,800 crore. It's a real testament to their ability to capitalize on that high $3,200 LME average we saw earlier. And as you'd expect, this solid performance is directly benefiting shareholders. The board recommended a final dividend of 1 rupees per equity share, which is 20% on the face value, totaling over 183 crore for the 25-26 financial year. But listen, paying out dividends and maintaining high profits requires way more than just hoping for good global prices. It requires intense internal discipline. Which brings us to perhaps the absolute most important strategic note from their report when it comes to analyzing their operating costs. Their secret weapon isn't just riding the LME high, it's a ruthless, laser focus on controlling operating costs through a reduction in specific consumptions. In smelting, shaving off even fractional percentages in your bauxite, energy, or caustic soda usage per ton translates to massive margin protection. They are actively lowering their baseline break-even point. By technologically optimizing these specific consumptions, NALCO protects its margins even if global prices were to suddenly take a nosedive. That brings us to Section 4, India's domestic demand. While the global export market remains volatile, the domestic picture inside India paints a story of rapid, sustained growth. As this breakdown brilliantly illustrates, Almost half, 48% to be exact, of India's booming consumption is being swallowed whole by the electrical sector. We're talking grid upgrades and the massive push for renewable energy. This is followed heavily by transportation and automobiles at 15% and building and construction at 13%. Indian aluminum consumption has seen incredibly positive, sustained growth over the past 5 years, driven entirely by these core infrastructure sectors. In fact, domestic demand is literally outpacing local supply. Just look at this gap for the 25-26 fiscal year. Total domestic consumption, which includes imports and scrap, hit a massive 6.12 million tons. But primary domestic production was only 4.29 million tons. That is a gaping 1.8 million ton hole in the market, meaning domestic producers like NALCO have a hungry, growing market right in their own backyard that is eager for every single ton they can produce. Finally, Section 5, Future-Proofing NALCO's Growth. Let's look at their outlook for the future given these market conditions. With domestic demand surging past 6 million tons, but global prices swinging wildly based on Fed rates and geopolitical tensions, NALCO has outlined a very specific roadmap. First, they're squeezing more out of what they have, unlocking higher productivity from existing capacities. Second, they're securing raw material linkages, which goes right back to controlling those critical operating costs. Third, they're expanding their refinery capacity specifically as a defensive measure to protect their bottom line against LME downswings. And lastly, they're leveraging strategic joint ventures to broaden their footprint. Ultimately, their absolute best defense is their corporate structure, because they operate as a fully integrated complex, meaning they mine their own bauxite, refine their own alumina, smelt their own aluminum, and even generate their own power from their own coal. They control vast portions of their supply chain. In a world of wild volatility, owning the entire chain from dirt to metal is the ultimate insurance policy. They clearly have the blueprint, right? The booming domestic demand is there, the aggressive cost efficiency drives to lower operating costs are in place, and their fully integrated structure offers a massive defensive mode. But, as we've seen today, the global macroeconomic winds of oil prices, interest rates, and geopolitics are shifting rapidly. So the question I want to leave you with is this. As we look past 2026, will this integrated cost-focused strategy hold strong enough to weather the next inevitable downturn in the global commodity cycle? Thank you so much for joining me for this explainer. I hope this deep dive into the numbers helped clear the air on where NALCO and the aluminium market are heading next.